do you want to finish by 10:40? Good morning and welcome to the panel discussion on mobilizing private capital to ensure a just transition and deliver on the SDGs. Thank you for bearing with us. We've had a few logistical challenges this morning, but we are ready to have an interesting and insightful conversation with our panel today. So this is the abbreviated version, so I'm going to get straight to it because I think we want to hear from our esteemed panel. So today joining us, we have Shinta Vijaya Kamdani, CEO of Syntesa Group and the co-chairperson of the GISD Alliance. We have Jay Collins, who is the Vice Chairman, Corporate and Investment Bank Citi. And finally, we have Karen Fang, Managing Director, Global Head of Sustainable Finance, the Bank of America. And I'm Loshni Naidu, who is the Chief Sustainability Officer at the JSE. So starting with Shinta, if you don't mind, what is the role for the private sector in ensuring a just transition and delivering on the SDGs?
Thank you. I think it's very, very imperative that the private sector look at investing in SDGs specifically on just transition. Because at the end of the day, we cannot just look how the economic aspect of it, but we have to look the social component, the responsibility, what impact it will done when we do the transition, right? And I just want to share a little bit the story of where I come from in Indonesia, where we are doing a huge program on energy transition. As you know, Indonesia is a very much fossil fuel-based country. We are now the country, the government has launched what we call the ETM, the Energy Transition Mechanism country platform, in which incentivize companies to do the energy transition. While we are looking into accelerating the renewable energy, of course, we have to also look at how we retire this coal. We talk about coal power plants. And this is actually an interesting example and how the model, what model will work commercially. But what I want to touch here is that because we are also a country where elevating poverty is still a very, very big issue, where we have 270 million people, we realize that when we talk about the energy transition, for example, we have to look at the just transition aspect, because what's going to happen with the jobs of these people? We have, as you know, a very low skill labor, and now we want to drive more into renewable. For example, we have to look at the job transition as well on the green jobs. We also need to understand the impact of the community. So we are looking not just about the access, if we talk about energy access, but also affordability. So this is something that I think when we look at the big picture, of course, investing in SDG, we talk about technology, we talk about the financing, but we also talk about the jobs. And jobs comprise also on how the social impact will be. So I just also want to share what we've been doing in the alliance is trying to really manage in bringing in also instrument in for more cooperation to understand how they can bring the SDG investment in SDG. And we have a big gap between developed and developing countries, and this is something that I think we're trying to now bring in more cooperation, more non-financial institution as well, because actually the past 3 years we have come up with many outcome that can be also utilize many more cooperation. I think the SIP on the infrastructure platform, as we know, on the blended finance and so forth, sustainable infrastructure, that's really an important key that can be utilized. The second is also on the SDG specific metrics. I mean, many companies are not even aware that we come up with such work. So we are trying to bring in more also socialization awareness of companies to understand, because where I come from, there's definitely still a big gap when we talk about investment in SDG. And I think the just transition aspect is just the side that everybody needs to look at, especially coming in from countries like us, which are still very much lagging behind. Thank you.
No, Shinta, a lot of the comments around just transition echoes with me coming from South Africa. I think there's a lot of similarities in the conversations that we are having as a country around how do we take our workforce along with us on this journey. So, Jay, I'm going to ask you the same question, if you wouldn't mind sharing your thoughts, please.
Sure. Let me, can you hear me okay, by the way? Just, yes. So let me make a couple broader comments and then narrow it down to just transition, which is a defined term. But overall, in terms of private sector role in the transition writ large, including the SDGs, I think one of the things that that we were actually talking about this morning is just the consensus amongst the sustainability committed private sector in the recipe. And if you were to actually take the last decade of reports from SMI, from the fantastic work of GISD, from the recent work of GFANS, and a plethora of other sources, the alignment on the recipe is staggering. We repeat ourselves over and over. We write more reports every year, and we say and recommend the same thing. And what is, again, we're a little bit in an echo chamber, because the groups like Citi and Bank of America that are always at that table, that are committed to sustainable finance, we are the willing, we are the committed, our ecosystem, our stakeholders commit us to sustainability and this process. And that's not necessarily true of the entirety of the private sector, but that is the group that is essentially recommending the recipe of what has to be done. And it's the same thing. So it's the enabling environment that we see in the JET-P process, for example. It's the creation of projects, because we just fundamentally don't have enough projects that have had feasibility analysis done on them. It's the crowding in of the private sector through risk mitigation tools, mobilization tools of the MDBs. And fundamentally then there is a side of this that is, what is the role of the policy world, the regulatory world, to crowd us in? And that can be as simple as, regulatory signaling, carbon rate mechanisms, for example, that incentivize carrots and sticks us to do the right thing, directly into mitigation or transition projects that are necessary to transition. But almost always in these situations, there is a social component. And specifically, just transition, as many of you may know, it comes from ultimately, at its beginning, at its core, it was a labor concept. It's a concept of disruption of labor in the transition process, and what are we doing for the employment jobs factor. And that is a public policy domain where the private sector can reinforce and soften the social blow. But ultimately, just like we've seen in the European Just Transition Mechanism, it requires a pot of money to be set aside from the policy community to participate in, alongside projects, the just transition process. So let's just take an example. We have an alternatives energy project in a country where there are large fossil fuel or coal facilities being early retired or shut down in that process. That labor needs to move. Communities are broken and need to be transitioned in the process. And that has to be coordinated with the private sector as those new projects and energy is transitioned, so that the communities that are disrupted through the transition process are compensated and also transitioned for the future of work potential of the green environment. So that's an early quick take.
Thank you very much, Jay. Karen, I'm going to turn to you. What are the greatest impediments to catalyzing private finance and investment for sustainable development and climate action? And why haven't initiatives to date, including blended finance, resulted in private capital mobilization at the scale that's required?
Sure. Thank you for having me today. And I think if I just, some of the points I think Jay hit on earlier, but just to answer your question directly, I think more emerging market and developing economies projects have a set of common risk factors that developed capital markets or developed regulated investors have a hard time absorbing without risk mitigating mechanisms. Currency risk. I do think that is a major issue where if you just think about, FX forward and how that's actually being calculated and essentially local currency based revenues with dollar or euro based financing, there is a mismatch, right? And obviously for emerging markets, which tend to pay higher interest rates, the forward currency rate is expected to depreciate. So when you do hedge those revenues, all of a sudden you have a financing gap from a revenue versus cost perspective. So it is not a unsolvable issue, but it probably needs a lot of diversification of a currency mitigating pool at the MDB DFI level to do it on a holistic global scale. Because on a project by project, country by country level, it is simply too costly. Even if you have great power purchase agreements for a wind project, for example, if you hedge back to dollars, those local currency based revenues will be worth less in the dollar terms because your hedging future forwards are expected to depreciate. That is a very technical conversation. The reason I wanted to go there is a lot of people talk about currency risk being a real major barrier because not everybody has the ability to financing dollars and euros in these countries. So that is one thing. Project risk is another thing, which is not unique to emerging markets. But for just transition to happen, we need to mitigate project risk in a country where stability and political environment and geopolitical environment sometimes adds a lot of uncertainty. Credit risk of the underlying counterparty, whether it's the sovereign, whether it's the corporations, project developers, revenue off-takers. Clearly, that's an added level of complexity compared to doing a solar project in the United States, for example. And obviously, then we go on to talk about political risk and other things, which Bank of America underwrote a $500 million debt for nature transaction in Gabon, and we saw a coup d'etat happening within days, right? That's exactly why we have political risk insurance in place. We want to do more of those transactions despite, uncertainties and volatilities. But it is a challenge. So I do think these risk factors have to be mitigated. But to Jay's point, when you think about a perfect de-risking solution doesn't exist. And we don't get to do these transactions without taking any risk. And we're the willing and the committed from a GISD perspective. We all want to help. But our regulators also have to potentially think about potentially a special bucket or different ways of SDG mobilization, not to treat it, these project financing as or company level financing, EMDEs, as a totally different thing, but create some sort of risk control bucket where we know we need $4 trillion a year, $1 trillion is needed in emerging markets. We're seeing at best $50-60 billion flowing there. And we have done more. I mean, we would have never done a debt for nature transaction had it not been for all the great work we're all collectively doing, because it's not riskless, as we just saw. But we have to do more of that, but we need more of the, I would say, enabling regulatory environment from all the banking regulators, insurance regulators, pension regulators to come in force as well.
Thank you. Karen, I'm going to go to Shinta. This one's for Shinta because we were chatting a bit about this before we started. But I think the points that both yourself, Jay, and yourself, Karen, have made around enabling environments and having the regulators on board. So it's about partnership. And Shinta, in the context of the UN's upcoming 4th International Conference for Financing for Development, how can the GISD Alliance leverage partnership to ensure just transition and deliver on the SDGs?
Yes, I think that's an important question. When we look at collaboration, partnership, right? And in one way, we've seen that what Karen point of view of involvement of the enabling environment needed the the right regulatory framework from governments. We understand that there is, again, I'm always talking about gap because there is definitely a big diversity in terms of how government are committed to providing the right enabling environment. So I think the jargon of private sectors, companies needs to invest is there, but whether the support of the government is there, I think is very. And I completely agree to the point that somehow we need government involvement and we need the government, to back us with the right policies in place, including mitigating the risks that we're talking about. So I think looking back at the history of the financing for the development, I think the importance of the conference is definitely to address emerging issues, including the context of the multilateral effort to promote the international development cooperation. I think the current involvement of the landscape, the interrelationship of all sources of development finance. We talk about the synergy between financing objectives around the three-dimensional sustainable development, and of course the need to support the UN development agenda beyond the 2015. But I think if we look back, for example, in this 2023, if we look back on what has happened, the last financing development forum, I remember that the call for stronger, for example, tax system was there, and more private and public investment for sustainable development and reforms of the international financial system to really allow more resources to be raised. And I think I wanted to share, for example, we just completed the ASEAN this year. And now the government has agreed on the ASEAN taxonomy, the green, what we call the green taxonomy. That's quite a big leap. I mean, coming from where we're coming from. So I think there needs to be a very much coordinated efforts from everywhere. And I always look at, the world. Each region has their own, kind of platform. How we can bring this together globally? So what we are trying to also do in GISD is to really bridge this, to bring more regional perspective and really be more inclusive in bringing the stakeholders. And I think there needs to be more communication and push to the government on what really is lagging, right? And, I always talk about at the end of the day, example, project pipelines. That's actually a very big, so it's supply and demand, right? At the end of the day, I think the project, hi, Marc-Andre.
I failed miserably.
No, you did.
No. So I think I just want to reiterate the importance of the multi stakeholder definitely partnership to make this work, and I think we need to bring some of the effort that has been done in other parts of the world and how we can really have a more reconcile and coordinated effort and bringing it together. So I think we look forward that this discussion will continue having a more really concrete outcome. And I think bringing some of the challenges, addressing the challenges, and learning what others has
So, ladies and gentlemen, we've been joined Marc-Andre Blanchard, who's the Executive Vice President and Head of CDPQ Global and Global Head of Sustainability, CDPQ. So we'll give you a second, and I'll go to Jay first, and I'll come back to you.
Nice.
Thank you for joining us. Do understand. So Jay, maybe just building on the regulatory comment that you've made. Sorry, I just lost my place for a moment. So just what actions do you think are needed to address the institutional and regulatory impediments to longer term investment so that businesses can effectively align their practices with sustainable development and climate action? And what can the GISD Alliance do here? Thanks.
So let me start with the last part of that, which is GISD can help ensure that the regulators are in the room for this dialogue, because we've had years of dialogue where sustainability, be it SDGs, including 7 and 13, and the climate world of policymakers and business leaders, philanthropic organizations, and NGOs are meeting without regulators. And therefore, we're missing part of the ecosystem that's fundamental to align ourselves to be able to accelerate the ambition of the transition. And so GISD can create, again, be part of the process to create an environment for regulators to be at that table. Why is that so important? And Karen's touched on that, but I'll just double down, which is that if for our viewers, listeners, if you go back to the financial crisis, we created regulatory frameworks to ensure that it never happens again. And be it Solvency II in the insurance space or Basel III in the banking space, a lot of the provisions that were put in place created duration, liquidity, credit, and other mechanisms that ensured the safety and soundness of the banking system. And when you looked at it from safety and soundness, prudential regulatory frameworks for banks, with that prism, we did a fantastic job. When we look at it from the prism of sustainable finance and energy transition, weak credit, think single B emerging markets, SMEs, small businesses, but importantly infrastructure, was made much more difficult to do. And so I said way before we put the word green in front of the word infrastructure, back at a time when I ran infrastructure for Citi, I said Basel III is fundamentally unfriendly to infrastructure. Well, now we have a bigger problem, which is it's fundamentally unfavorable to green infrastructure. And off-balance sheet project financing is fundamental to transition. In fact, it's the preponderance of alternative energy financing that will happen through the project financing, and the Basel III, particularly the G7 and particularly the US regulatory frameworks, are not only not enabling, but those frameworks challenge banks. So all we're asking for is to have, let's just say, the policy and regulatory community as it sits across from the GFANZs, from the banks, the insurance, the pension funds of the world that are trying to help to align themselves to have a similar dialogue with us about what exactly you want us to do. Because if we listen in this ear to the regulator, it's very different from what we're hearing in this ear from the committed climate sustainability policy leader. And we think, therefore, that that dialogue, however we come out of that room, we all need to be in the room.
Thank you very much, Jay. So Marc-Andre, I'm going to go to you. So what are the greatest impediments to catalyzing private finance and investment for sustainable development and climate action? And why do you think initiatives to date, including blended finance, resulted hasn't resulted in private capital mobilization at the scale that's required.
Well, thank you, Lashni. Thanks to everyone. Is this working? Yes. I just want to build a little bit on what Jay said. I totally agree, and it's the link between the impediments here that I'll try to cover. But when I was walking here this morning, I saw the tagline of the COP, which is Unite, Act, and Deliver. And when people ask me, what's the importance of this COP, actually, I think one important feature is that for the first time, the private sector is here in such a large scale. It started in Glasgow, but that's 2 COPs away. And so it's relatively new. And to do what we need to be doing, we need to do a lot of investments and a lot of infrastructure. So yes, we need the regulatory framework that we've been discussing, that Jay has mentioned, and there's some impediment there. I mean, Basel III has proven to be a big impediment to financing infrastructure in emerging markets. But I think it's very clear now, what we've said, listen, there are institutional investors, and I represent an institutional investor. It's a CDPQ from the province of Quebec. We are the largest investor in infrastructure in the world amongst the institutional investor. And what we see is there's a lack of bankable projects in many places, even in developed countries, actually. That's not a problem solely of the developing world. It's actually, we need to be doing projects and at scale and rapidly, and actually the pipeline of project is not there for all sorts of reasons, good and bad. The second is there are risks that because we have fiduciary obligation, 6 million people are counting on us to pay them a pension when they retire. We're not a philanthropic organization. So there are like institutional investors like us, which now control more than half of the investable capital in the world. Yet no instrument is actually adapted really to us. And that's a big issue. So the Bretton Woods institutions we created 70 years ago when there was basically no institutional investors. And so what we need to adapt quickly are the tools to de-risk, to develop projects, and there are ways to do that. And we need catalytic financing for first loss investment, for first loss. Then the second is we need to deal with foreign exchange risk mechanism that will protect it. I mean, they exist, but on a small scale and at a very high cost. And at the end of the day, in emerging markets, the big elephant in the room is the cost of capital. And we need to find ways to reduce that cost to go in some of the emerging markets if we want the transition in the South to happen. And we all believe that, I believe it's essential for a transition to happen, that the transition also happen in the South. So it's about de-risking instrument, pipeline of projects, and the last one is access to data that the MDBs have. A big problem is we tend to overestimate the risk and underestimate the opportunities in some markets. So, there are some players like the MDBs of the multilateral world that actually have experience in emerging markets. They need to share the data way more than what is on the table at the moment, because what would happen is it's going to reduce the price of financing, because it's going to reduce our perception of risk, and this is key. And I just don't understand why it's not moving faster, really. I mean, it's a very simple thing, like access to the database of the World Bank and the others, and what is on the table at the moment is very small compared to what it should be. We should be all transparent about this. We have no time to quarrel. That's why it's important to be here to unite and act and deliver.
Oh, thank you so much. That is such a wonderful way to actually end where we're at. And unfortunately, I'm very sorry that we have officially run out of time. But just a last couple of thoughts. Just to reiterate who the Global Investors for Sustainable Development Alliance is. It's a group of leaders of major financial institutions and corporations across the world. It is convened by the United Nations Secretary General to deliver solutions that scale up private finance and investment to achieve the SDGs, including SDG 13, on climate action. Thank you everyone for joining us and listening to our amazing panel that has raised a number of issues, such as the various risks that we face, but also the opportunities to work towards unite, act, and deliver. So thank you. Thank you very much.
Yes. You want a picture, Chantal? I want a picture. You know, I should look at my stats. I'm sure I'm already at 25.